If the debt is now in a trust, how's this trust going to be positive in any way?
High income, multiple income sources are really the people that this gives the biggest potential benefit to.
My head is spinning here because this is new and it creates a lot of potential implications and things that we can talk about.
This structure could very quickly be quite unsuitable to what you're looking to do, and you might have to reverse yourself out of it to go in a different direction.
If you did it to begin with, you make it even harder for yourself to borrow going forward. A big new lending opportunity is here for property investors right now. It's this unique opportunity where you can move your personal debts that you have for properties you own in your personal name into trusts now. Yes, let me say that again. You can move the debt that you own for properties held in your own name into trusts now. This opens up a lot of strategies for you to potentially expand your borrowing power and purchase additional investment properties if that is what you're looking to do. Now, this strategy comes with a lot of strings attached and has so many bells and whistles to it that we need to explore them one by one. And in this episode, we're going to go through strategies for you to go and harness this approach for you to build your property portfolio if that's what you're doing. Curtis, the lending whiz, you've told me all about this.
Yeah, this one is very exciting. This is like for people in lending, like a new country just got discovered on the world. And it's like, cool, we get to go check out like this whole new country that didn't exist before.
It is a lot like that, right?
Get off the plane, like, what is this?
Feels a bit like that, right? Yeah, we're going through the forest and be like, wonder what this looks like, wonder what this looks like. We've started putting in a few applications like this as well. So we know it works. We've seen it. We know the lenders it works with. It's very powerful. We've seen the journey work. But can you explain to everyone simply what has changed and why does it matter?
Yes. So previously, the situation was always nice and black and white. You can be a property investor. You can own assets in your personal name. You can also create a company or a trust structure, and you can choose to own assets in a company or a trust structure. But you can't do both at the same time because that would be weird. Now you kind of can. So what's happened is some banks, and again, this is a very, very small segment of lenders that consider this or even think about this. This is not a mainstream, you waltz into your local ANZ branch and tell them you want to do this. You're going to be met with very blank stares. Some lenders are now allowing you to own an asset in your personal name. So you're Mr. Property Investor, Mrs. Property Investor out there, and you have an investment property. You're on the title as the individual, and the loan's in your name because that's how you got it. That's how everyone got it. They are now saying, if you have a family trust or a company, we are willing to consider refinancing that loan into your trust structure or your company structure. So the trust or the company becomes the entity that has the mortgage. They're the borrower. But you can keep the asset in your personal name. We're not going to make you change who the legal owner of the property is. Because you're the director of the trust, you're providing the guarantee. We know who you are. We know it's your family trust. The fact that you own the property personally, whatevs. That's kind of where they've landed. But doing what we do, working with people building investment property portfolios, that opens up a range of new ways you can choose to hold your assets to try and maximize where you can grow your portfolio.
And your debts, right? You can choose where you can hold your debts.
Yes.
Right? Is that
correct? Yeah.
This is so interesting, Curtis. I got so many questions. I'm a property investor. I'm gonna be the audience here for you, and I'm interviewing the man, the whiz. I got so many questions here. Let me start with. So, should I do this? I am just somebody buying my first property. I was going to buy it in a trust. I was planning on doing that, but I'm buying in Melbourne, and buying a trust in Melbourne kind of sucks. I'm buying a trust to protect my borrowing power. That's the only reason why I'm buying it. It's got a 3.5% yield. That's what I'm being shown. And I really want to buy it because it's a really good property at the right time. It's good. It's going to make me a lot of wealth in the long run. Should I do this? Now I don't need to. I can put it in my personal name. How cool is that? I want to do that because I get to claim some gearing and it's pretty and it's simpler. But this trust thing, they can just hold the debt now. It doesn't need to hold the asset. Should I do that?
Don't do that.
Don't do that.
Please don't do that.
Okay, sure.
Yeah.
Nice, simple, clear. Can you help me understand why I wouldn't do that?
So, if you are in that situation where you're early in your investment journey, you're buying your first investment property, or you're buying in a trust to protect your borrowing power, and then maybe looking at one day buying in another trust going forward. The downside, some of the strings attached to this strategy, not many lenders do it. And the lenders that do it now, unsure how long they're going to keep doing it for.
They've told us that, right? We met with them a couple days ago.
Lenders, I'm sure no lender wants to be famous in Australia for being the only bank that does this. Like, that's not where, I don't think that's where any of them want to be. And if they found themselves in that situation, they would turn the taps off, basically.
Yep.
So by doing this, if you set yourself up in this structure and you're looking to buy 3, 4, 5 investment properties over the next 3, 4, 5 years, maybe you want to release equity. In 1 year, you might not be able to refinance this property out to a different bank to release equity.
Yeah, you can't.
Yeah. You go and get 10 valuations from 10 different banks. If none of those banks allow this structure, like, useless. You are very, very restricted and trapped in what you can do.
Oh, no.
So if you're starting your journey,
I don't want to be trapped.
like, you need to set yourself up in a structure that the majority of lenders accept, because that gives you the flexibility to move around between banks as you need to, based on who gives you a good valuation. What are you trying to do? Do you need more borrowing power? The more options you have, the better you can navigate your lending journey to get to where you want to go.
For sure.
If you're using this strategy, you are looking at very, very few options.
For sure. Okay. So thank you. That explained it pretty clearly as to the limitations of this. But there's obviously another limitation. So I'm going to move back into just co-host with you now. But there's another limitation to this as well. Like, the whole trust strategy relies on the trust being self-sufficient.
Yes.
That it pays for itself. Now, if the asset's held somewhere else and the income of that asset is held somewhere else, because that's all based on the title, not on where the loan is.
Yeah.
The loan is at. So the income is there where deductions, where it appears on your tax returns and things like that. It's based on the title and who the owner is.
Yep.
The owner doesn't change it. It's still the person.
Correct. Yep.
But if the debt is now in a trust, how's this trust going to be positive in any way where, like, it's going to require my personal contributions to actually meet its obligations? So doesn't it just defeat the purpose?
Yes,
in its own?
Yeah, it can. So if you're using this structure where you were to create a series of trusts to hold your, 3 trusts to hold your 3 investment properties, and they don't do anything else, you're a PAYG income, you're on PAYG income, you don't have any self-employed income, then yes, it's very difficult to legitimately use this strategy to actually take you any further, because for that very reason you mentioned, these trusts are going to have the liabilities, but they're not going to have the rental income in them. So this strategy is much better suited and really targeted to people that have trading trusts or companies where they're earning income.
Ooh.
So you're earning income, and then you might choose to set a liability that offsets that income, if that makes sense.
Well, that makes a lot of sense. You're very clever. I don't think anyone understood that, though, because we're talking about a very complicated setup here. So you have found a way to get, if you don't have any, if you're not self-employed and if you don't earn any income in trusts or business ventures at the moment, what you're going to be in a situation is you don't have any income that goes into this trust, and it's going to be very hard to make it self-sufficient unless your accountant can find a way to move income in there from the rental income of the property. I don't know too much about that. We don't know too much about that. An accountant will be able to help you. You need a good accountant on your team to work out whether you can do that. So if you're not self-employed, then it's like, oh, okay, this strategy may have roadblocks that don't take you exactly where you want to get to. But if you are self-employed and you have a trading trust where you can move that income around over time and distribute it to where it needs to go to, you can have that income go towards that trust that holds the debt. And now that the debt is self-sufficient in that entity, it has income there from the trading trust that you have. So there's the potential to use this if you're high income, if you're self-employed, if you're really, really strong type borrower. that creates opportunities for strategizing in terms of where the asset is held versus where the debt is held over time. And it adds another layer of questions for property portfolio building for people in this situation.
Yeah. So high income and multiple income sources, I would say. High income, multiple income sources are really the people that this gives the biggest potential benefit to, because it opens up a range of structuring options that can really, really materially benefit you. As you have less income sources, so if you're self-employed and you have a couple of different businesses, then that's multiple income sources. Yep. You're in a much better position to take advantage of this. As you strip that back and you have one income source or you're only PAYG, it becomes harder to make this achieve much for you that the standard trust structure wouldn't.
Yes, I get that. So many. My head is spinning here because this is new and it creates a lot of potential implications and things that we can talk about. And the upside of us talking about it is it showcases to everyone that it is new and we're working out different strategies and how to utilize this. My takeout here is it's dangerous to use if it's just your pay-as-you-go worker and you're trying to buy your first couple investment properties.
It's
too complicated, it doesn't suit, and it doesn't actually help you. It roadblocks you in the same way as a trust. It might roadblock you even further because the trust won't be self-sufficient at all.
Yeah, exactly. Yeah. So I would say, and some of the conversations that we've been having with people could be very useful for someone that has self-employed, a couple of different income sources, has a couple of investment properties already, and is in the window where they're like, hey, I want to make a PPOR purchase. I want to make a PPOR upgrade. That's where this policy can really, really help. Get them a higher PPOR borrowing power than they would otherwise be able to do, change the way their affairs are structured, facilitate that happening.
The one that I can think of here is, this one requires good servicing as well, but the one that I can think of here is a property investor who has multiple trusts already and multiple property investments in their personal name. Some of the conversations I have with these property investors is, I wish this wasn't in my personal name.
Yeah.
But they already have trusts. Now, some of these trusts may be substantially positive. Yep. Like they could have bought in Darwin 2 years ago and rents have gone up a lot and they paid down the debts. Or they got it with a 70 LTV or some version of that. And it's, spinning off a lot of positive cash flow. And their structuring could be set up correctly where they might be able to move that personal debt that they have into the trust.
Yeah.
And the trust can remain self-sufficient here or close enough to it that then opens up that borrowing power in their personal name again. Have I potentially nailed a strategy there?
Yep. Yeah. I think that
advanced investors.
Yeah, I think that works for advanced investors.
Yep.
I would just say, I think it's more about, in order to utilize this, you have to have an end. You have to have some actions that you're taking. So whether it be acquiring more IPs, acquiring a PPOR, you have to have some things that you're trying to achieve in a relatively short amount of time. I don't think this is a strategy that's really that useful for, a speculative, I want to, this might come back to help me in 10 years time kind of thing. I want to refinance and create this separation now and then, but maybe I want to pull equity in a year. Maybe I want to do this. Maybe I want to do that, because it's going to narrow down what you can do in the future, which banks you can use. It's going to narrow down a lot of things. So if you have a clear objective of hey, I want to achieve X, Y, Z things in the next year or the next couple of years, this is my plan to do it. My current structure is creating a couple of roadblocks for me. Then this might be a way to help, but I don't know. I would be saying you just necessarily set this up
for sure.
Without a real goal in mind, because if your goals change, this structure could very quickly be quite unsuitable to what you're looking to do, and you might have to reverse yourself out of it to go in a different direction.
Yeah, for sure. So let's go through the live example that we're working through, the ones that we've already seen happen. So in this case, the investor himself, he unleashed over $1 million in personal borrowing power, and he's using that to buy in Melbourne. So how did he do it? He's got a number of companies. He also is self-employed, makes a decent coin in that entity. It's like a side hustle he has. He's pay-as-you-go worker, but he's got business income there that goes into his trusts. He has moved his personal debts into this setup,
Yep.
so while keeping the ownership in the personal name. So the debts itself are now covered by the income that he gets in his trusts.
Yep.
And as a result, on his next loan application, he was able to go and get an additional $1 million in borrowing power to go buy that Melbourne asset. And he completely flipped the script on his strategy. And it's just like, hey, look, I need to pivot my strategy because lending has pivoted. So I'm going to pivot with the information that I have on hand. Give me a chance to do this. And yeah, he's in the process of purchasing right now. He's got his pre-approval. He's ready to buy. He's just looking for the asset right now.
Yep.
And it's suited his portfolio strategy significantly more in this case. And he's not so worried about the equity release and the future impacts here because he's got this particular investor has 7 properties. And
the goal is it gets me to my next investment purchase and materially changes what that purchase is, right?
Exactly, yes.
Like it gets me a better quality
Yep.
asset, and like if I pull the trigger on this, it gets me, inside 3 months, it gets me to a better outcome than I would have been at not doing this.
Yeah, this guy was going to sell an asset as well to get the achieved outcome. Like it was like, I think his budget was around 400,000 otherwise, and he's like, oh crap, I'm gonna have to sell one of my assets in my personal name. It's dragging me down. That's the one he moved across. So instead of selling, he's managed to recoup that borrowing power without selling as a result. So it's been harnessed well, but he's the exact type of borrower that fits all the profiles. He earns income in a trust. He's going to keep that trust positive. He's an advanced property investor. He's already got companies trust. It suits him a lot, which is very, very different to the opening question I posed at you, which I think would be the majority of the audience being like, should I just start doing this to start with? Cool new strategy. Let me go do it. Like, it's not as simple as that. And it doesn't mean you have unlimited borrowing power doing this. It doesn't at all. If you did it to begin with, you make it even harder for yourself to borrow going forward. If you're pay-as-you-go worker buying your first property, you buy in your personal name, but you put the debt in a trust and you try and keep purchasing. It's more than likely that that trust is not self-sufficient. You're not going to be able to go get equity releases on it. The banks aren't going to like it. And if you're on normal income, that ain't going to work. It's not sustainable. And even if you have a friendly way of saying that trust is positive, I don't know how you're going to do that. It doesn't make sense. The trust is, the bank's going to say it doesn't make sense. So going forward, it doesn't make sense at all. This person has just blocked them because they've got the debt there and not the income. It doesn't suit that person at all. Flip the script a little bit and it's just like, hey, the right person, the right property investor, the right advanced sort of strategies, it can make a big difference. We kind of represent the full gambit of property investors and we see a lot of different situations. This suits some, but it's really a tailored approach. Is that a fair summary?
Exactly. And the other, another example that I'm, working on at the moment is a little bit similar, but it's someone that's got 3 investment properties all in their personal name. 3 properties, PPOR, 2 IPs, wanting to do a PPOR upgrade and ideally doesn't want to liquidate any of the existing assets, just wants to convert the existing PPOR to an IP. It's kind of like, look, the scenario before this is like, I'm not sure that's really going to work out. You're probably going to have to like choose one to sell in order to do the PPOR purchase you want. Now this opens up a second option of it's like those existing liabilities can be moved into a trust. Again, self-employed, multiple income sources. He can have that trust be self-sufficient. And then you're free to kind of go and do a PPOR purchase with that unleashed borrowing power. Basically, you can do that in your personal name. And the 3 properties that you're going to retain as IPs will have the debt sit in a trust. And then that way you get where you want to go, but you don't have to sell. But again, I would say a very sophisticated, advanced investor with multiple self-employed income sources. This isn't someone that's trying to do a first purchase, trying to use high LVRs. That's probably another thing to color off. Like there's no chance this works at high LVRs.
It's an 80%.
80% or below.
The lender doesn't even like loans above that.
And no, like if you're trying to send this to an LMI provider, like a total waste of time. So
reports, most of them are reporting on the credit file anyway. So
exactly.
The whole LMI strategy with trusts, I think anyone employing that, been saying it a little bit, that's probably going to be debunked in the future. It's going to actually railroad them because the
we've
LMI
already
providers,
seen this a few times. That LMI providers are starting to
report it.
They don't list it on the credit file, but if you're doing multiple applications at 90% LVRs, there's not that many LMI providers in Australia. So regardless of what's on your credit file or not,
Yep.
If the LMI provider knows that they've approved the loan for you a year ago in a trust, then they are like, well, like, we look up your profile as well. Like, we can see we gave you 4 approvals. Like,
For sure.
why are none of these debts disclosed?
For sure.
So yes.
Let's break this up into a second episode, Kurt, where we go through a Q&A. I want to go through a Q&A where we deep dive into all of the questions here that others can have. I've only just started scratching the surface here about this strategy. This is kind of a big deal, everyone. Like, we talk a lot on this podcast. I'm getting good at that. But this is new. It's absolutely breaking, I guess, if we want to call it that. Maybe that's the wrong word, but it's a new strategy that you won't see too many people talk about, too many people understand, and work out exactly whether it suits you or not. And it is probably one of the first times you're hearing this, because there's not that much content or people talking about this just yet. So in the spirit of that, let's go through deeper and deeper and understand it better in our next episode.